Good morning. Welcome to Stock Market Today. It's Tuesday, April 21st, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show as well as give you daily stock ideas to consider. It hits your inbox every trading day before the market opens. So U.S. equities were lower in Monday's trading, closed near the worst levels of the day. Utilities and REITs were the worst performers. Energy also lagged as the front month contract traded below zero. Oil traded in negative territory yesterday, folks. Healthcare outperformed, though all sectors were lower on the day. Treasuries were stronger with the curve flattening. Dollar was stronger on the major crosses. Gold was up 70 basis points. WTI crude, the June contract, settled down 18.4%. It was the May contract, which expires today, that was in focus as it traded below zero before that expiration. As we get to the desk this morning, futures are down about 1.5% after U.S. stocks closed lower yesterday. Asian equities were under pressure overnight, and European markets are down over 1% here this morning. Treasuries are stronger across the curve. The dollar is stronger against the euro, but weaker on the yen cross. Gold is off 20 basis points, and that June contract for WTI crude is down 16.8%. So a lot of carnage in the oil patch. You all know what I've been saying about energy stocks for months now. Taking a look at the structure of the S&P 500, we can see that we stalled at the 50-day moving average, right? Tried to push through, couldn't get there, actually closed below the previous day's lows yesterday. So if we think about a stalling out and a potential move to the downside, I think 2730 is initial support. Below that, the key retracement levels kind of come into play in the 2450 to 2600 area. Resistance is in the 2850 to 2900 zone. Now I have tweaked that down a little bit to account for the fact that we've now failed twice at the declining 50-day moving average. That 13-period CCI, as a measure of overbought, oversold, is leaving overbought in the near term. And Chaikin money flow is bullish. So a mixed bag for the indicators. Market stalling at the 50-day moving average. Oil under pressure, likely weighing on sentiment across risk assets. And if we think about just the level of volatility still in the market, here's where, if we look at the chandelier exit, 21-day ATR with a 3 multiple, it's down here at about 2560. So in that support range that we were highlighting, but still well below current levels, gives you a hint that volatility in the market is still elevated. Taking a look at the market in a minute now, what are we writing about? Stocks declined modestly, and in our note today, we're highlighting the key downside support levels. Should this be the beginning of a retracement of the lows from March 23rd? Technology continues in a relative consolidation, while materials show signs of a relative bottom. We're not there yet, but we are seeing some signs. Equal weight S&P 500 paints the picture of large cap leadership. We'll take a look at what that means a little bit later on in the show. And as I said, futures do point to a lower open here today. So taking a look at the major indices, and I say modest decline because to me, in this current environment with a VIX around 40 plus, anything less than 2% is modest in my opinion. The Dow was down more than that, 2.4%, 4 bulls to 9 bears there. S&P 500 down 1.7%, 47 to 156 bulls to bears. NASDAQ was an outperformer on the day, 20 to 27 bulls to bears as it lost 1.17%. And small caps were a slight outperformer as well. 170 to 384 bulls to bears. A little bit of a flight to safety sent bonds higher and yields lower. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain bearish. Our stock of the day is not really a stock. It's the USO, the United States Oil Fund. And I wanted to take a look at it here today because obviously it was oil is all the rage in the news. I mean, what we saw yesterday was historic, right? Negative price for oil. That basically indicates that the cost to store oil is more than the cost of the actual commodity. And USO, I got a lot of questions about this on a call last night, as well as in the class that I teach at the technical analysis class that I teach. So I kind of wanted to address it here today. USO holds futures contracts, right? So as one contract expires, they need to maintain their exposure by going out on the futures curve. And the futures curve is generally in contango, meaning futures prices are higher than current spot prices. So when that roll happens, it's actually a drag on you if you own USO in the long term. And you can see, right, it roughly tracks oil, but you do have that contango drag to deal with. So I get a lot of questions about this product. And obviously it's at the lows and under a little pressure today again. Underperforming the SPY, getting close to an oversold condition while Chaikin money flow is bullish. But it's just, you have to know what you own when you own some of these exchange traded products, right? And this product that owns futures contracts has to pay roll costs as it rolls out to the next contract, right? So at the close yesterday, the front month contract was negative, but the June contract was trading at around $22. Somebody has to pay that cost. It's the holders of this fund if they hold it for a long term. So just wanted to clear that up here a little bit. The sector tracker today, looking at the movement over the last 5 days of the major S&P 500 sectors. Healthcare, one of our faves, remains at the top of the list. Amazon continues to drive discretionary higher. Now, last week in my note, I highlighted the fact that equal weight discretionary was not performing as well as the cap weighted sector. That's largely a function of Amazon's large weight within the cap weighted sector. Communication services, tech, and staples are also positive by a meaningful amount. Industrials calm flat over the past 5 days. Losers over the past 5 days: utilities, REITs, fins, materials, and energy, right? So the bond proxies remain under pressure even as rates go lower. Financials are feeling the impact of that lower rates. Energy and materials, right? Energy obviously has oil to contend with, but slowing global growth is not good for these groups. Now, materials is showing some signs of relative stabilization. We'll take a look at that chart. I'm not there yet, but we will take a look and you can see what I'm talking about in that regard. Our industry in focus today: retail services, which over the past 6 months has lagged the S&P 500 by 17.6%. And that power bar ratio, which is a measure of future potential, is weak. It's very weak, actually. Only 6 bullish stocks for 30 bearish stocks. So 5-to-1 bears to bulls in the ratio. It's currently ranked number 13 of 21 subsectors. Some of the names there with very bearish ratings that we want to avoid: Monroe, MNRO, Tiffany, TIF, and Grubhub, GRUB, as I said, all with very bearish Chaikin power gauge ratings. And if we take a look at the fund itself has a neutral ETF rating. There's that ratio, 5-to-1 bears to bulls. Weak trend below a declining long-term trend line. We've had a rally off the lows with the broader market, but it's been an underperformer since the start of the year and continues to be an underperformer. Fund is now overbought with mixed to slightly bullish money flow. Hard for me to get excited about retail here. Obviously, a lot of stores remain closed. I think there's a little bit of hope in this rally from 26 to 34 that the worst might be behind us, but hard to say yet. And again, a lot of the retailers report off calendar, so we're not going to hear from them in terms of their earnings reports and guidance for a little while now. Me personally, I'm not a fan of retail here. I think the risk reward skews to the downside. XRT, if we look at the fundamentals of the companies underlying the fund, that speaks to the same dynamic. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers, the gainers and losers. FLIR, F-L-I-R, is a bearish stock that rallied 14% and is up again in the pre-market as Amazon said that they were going to begin to use thermal cameras on some of their employees to take their temperatures, and FLIR makes thermal cameras. DuPont gave some guidance on the quarter, which was better than expected, but they did pull their full year guidance. Stock was up 3.5%. Netflix, they report tonight after the close. Stock has been an absolute monster. Some positive previews from the sell side helped to send that stock higher. They do report tonight after the market closed. Alexion initiated a phase 3 study, and that has some investors excited, up 3%. Tyson TSN saying that they were going to resume some production in a limited capacity in their plants. That sent that stock higher 2.5%. On the loser side of the board, VNO, CEO taking a pay cut. L Brands, no real news there. Part of the retail landscape, down 9%. Same goes for Van Heusen. Down Phillips Van Heusen, PVH, 8.91% to the downside. Nothing company specific driving those two names. VTR, 8.5% to the bad. as the senior housing REITs came under renewed pressure again yesterday. Las Vegas Sands didn't see a lot of news on that one, down 8.25%. They are scheduled to report earnings tomorrow night after the market closed. So keep an eye on Las Vegas Sands. Obviously, a lot of leverage to China there, obviously leverage to the gaming, lodging, and leisure space, right? So we're going to want to pay attention to how that stock reacts following their earnings announcement. So let's dive into the charts now. It's Tuesday. It's relative strength day. One of our favorite sectors for a long time has been technology, and you can see why here. Look at that relative chart of XLK against the SPY. That is a textbook uptrend above a rising 200-day moving average. However, something that we do want to point out is we're now in this consolidation. And something I've been pointing out for a couple of weeks is that the RSI has been making a series of lower highs. That is a bearish divergence, right? Especially here at the high for the ratio. RSI made a lower high. That's a negative divergence. It's not immediately a sell signal, but you want to watch for a breakdown. To me, if we started to see a break through some of these valleys in the consolidation, you might start to argue for a trend reversal from a relative perspective for technology. We're not there yet. It's similar to what we saw in the S&P 500, right? Back in February, there was a negative divergence when the market made a new high on February 19th. Fast forward 5 days to the market gapping through support at 3250 and the 50-day moving average. That was your signal that confirmed the bearish divergence that said the risk was now to the downside. So that's how I'm kind of shaping up technology here. Right now, the trend is still very much higher. This looks like a consolidation, but we would be remiss if we weren't paying attention to the negative divergence at play, especially when we look at tech on an absolute basis, and we can see the rising trend line off the June lows is now being tested from below, and so far acting as resistance. So building the mosaic, running through the if-then scenarios, paying attention to what the market is telling us, while at the same time continuing to respect trends until something signals that you should do otherwise. Taking a look at XLB now, the materials sector, on an absolute basis, hit the 50-day moving average and, former support, now resistance, and beginning to turn lower. Now, the RSI is trying to shift into bullish ranges. We'll see if that can hold. So kind of an interesting dynamic at play here. First time in a while we've tried to see this shift, so we'll see if it can continue to play out. Still very much a downtrend on an absolute basis, but if we look at the bottom of the chart, XLB relative to the S&P 500, it looks like we're building a support level that's been tested a few times and so far holding. This is what I mean when I say we're seeing signs of relative improvement in materials, potential base building process. So again, what you want to look for is some upside that starts to break through some key resistance levels to give you an indication that maybe the relative trend for the materials group is changing, right? Some people starting to talk about a potential reflation trade, right? A lot of people talking about the potential for inflation, given the unprecedented stimulus and quantitative easing by the Fed. I think that if that is your thesis, you need to check yourself by checking velocity of money as well. The Fed's been printing for 12 years. And for the most part, inflation has failed to materialize. That's largely a function of declining M2 money velocity. So pay attention to money velocity if you are going to try to argue for the inflation trade based on money printing. And then finally, I wanted to take a look at the S&P 500 on an equally weighted basis, right? We've been arguing for a long time that large cap is the place to be, and this kind of bears that out. Looking at the RSP, you can see a rally to the 50% retracement level now beginning to fade, exiting in overbought condition, but the relative is what tells the story here. Relative to S&P 500, we are in a precipitous downtrend, trying to build the base here a little bit, but still a lot of pressure. That is your signal that large cap stocks are accounting for the majority of performance. That's going to wrap us up. Take us for a test drive, chaikinanalytics.com/test drive.